Hey everyone, welcome back to Corporate Decoder, the place where we dig through the fine print so you don't have to. Today we're diving into NioCorp Developments Limited's latest report, a 10Q filing that is packed with numbers and future plans. Prepare yourselves, because this one's a roller coaster of financing projects. And a whole lot of striving toward that big goal. And hey, before we get too deep, if you are all about getting the real story behind corporate filings, make sure you hit that subscribe button. Also, we've got a fantastic community over on our Discord server, linked right below in the description. It's the perfect place to chat about these reports and get more insights. Alright, so NioCorp is filing their quarterly report, a 10Q, and this one covers the period ending the 31st of December 2025. Think of it as a mid-year checkup for the company's financial health and operational progress. They are a development stage company, meaning they are focused on building something big, in this case a major niobium scandium and titanium project called the Elk Creek project, and of course building something this massive requires a serious amount of cash. Let's jump right into the numbers. On their balance sheet, as of the 31st of December 2025, NioCorp had over $306 million in cash and cash equivalents. That is a huge jump from just shy of $26 million back on the 30th of June 2025. This massive increase in cash tells a pretty clear story they've been raising money. And a lot of it, their total assets also leaped from about $44 million to over $348 million. On the flip side, liabilities also grew, with warrant liabilities and earnout liabilities increasing significantly. This is typical for a company in their position, as they issue these financial instruments to help raise capital. Now, let's talk about their performance, or in this case, their losses. For the 3 months ending the 31st of December 2025, they reported a net loss of about $1.2 million, which is actually an improvement from a loss of about $518,000 in the same period in 2024. However, looking at the longer 6-month period, the story shifts. For the 6 months ending the 31st of December 2025, NioCorp reported a substantial net loss of nearly $45 million, a drastic increase from a loss of around $2.6 million in the same period of 2024. This widening loss is largely driven by a significant increase in exploration expenditures, which shot up from around $400,000 to over $11 million. They are clearly investing heavily in getting the Elk Creek project ready. Looking at where the cash is coming from and going, NioCorp used about $7.5 million in operating activities for the first 6 months of 2025. This might not seem like much compared to their enormous losses, but it is a notable increase from the roughly $2 million used in the same period of 2024, where they really saw a massive cash inflow was in financing activities. In the first 6 months of 2025, they brought in over $311 million from financing, a huge leap from just about $450,000 in 2024. This aligns with the balance sheet's massive cash increase and highlights their reliance on external funding to keep the lights on and the project moving. Investing activities, on the other hand, used over $23 million in 25. Mainly for acquiring mineral rights and some manufacturing assets. In the shareholder equity section, you can see the impact of all these financial maneuvers. The number of common shares outstanding has grown dramatically, from around 58 million in June 2025 to over 120 million by the end of December 2025. This shows a lot of new stock being issued, which is how they've raised so much capital. But it also means existing shareholders might see their ownership percentage diluted. Their accumulated deficit also grew, which is not surprising for a company in this stage, but the capital injections are clearly keeping them afloat. So what is the core business here? NioCorp is all about developing this massive niobium, scandium, and titanium project in Nebraska. They do not make any money from operations right now, and they need tons more cash to get to production. They also recently bought some scandium alloy manufacturing stuff, which they hope will help them create a domestic supply chain. Now, the big question is always liquidity. Can they pay their bills? As of the 31st of December 2025, they had a hefty cash pile of over $306 million and a healthy working capital of nearly $298 million. Management believes they have enough funds to cover their immediate needs. But here is the catch: they will need a lot more money to actually build and run this project. They plan to get future funds from debt, more stock sales, and other sources. This is the perpetual challenge for development stage companies. This section delves into some of the more complex liabilities, like their earnout shares and warrant liabilities. The earnout shares are valued using a sophisticated model, and their fair value changed significantly, increasing over $10 million in the last 6 months of 2025. Similarly, warrant liabilities more than doubled, jumping from around $6.8 million to over $13.7 million. These are all tied to the value of NioCorp's stock and the market's perception of their future prospects. This is where you see the fruits of their fundraising. On the 18th of July 2025, they had a registered offering and brought in about $41 million. Then on the 19th of September, another registered direct offering added nearly $46 million. And get this, on the 29th of September, they had another public offering that raised over $55 million. But the biggest one was on the 15th of October 2025, a registered offering that raked in nearly $139 million. It is clear these offerings have been their lifeline, providing the cash to keep the project moving. Let's look at warrants. These are like options for investors to buy stock later at a set price. Their outstanding warrants change quite a bit. As of the 31st of December 2025, they had about 19 million warrants outstanding. Some of these have exercise prices as low as $1.75, while others are as high as $11.50. The market's perception of NioCorp's future value will directly influence whether these warrants get exercised, and in turn provide more capital. Here we see the actual spending on moving the Elk Creek project forward. For the 6 months ending the 31st of December 2025, exploration expenditures were over $11 million, a massive jump from just about $400,000 in the same period of 2024. This includes technical studies, drilling, and other fieldwork. They also received over $6.8 million in reimbursements from the US Department of Defense, which is a nice boost, but most of it is currently recorded as deferred income, meaning they will recognize it as they hit project milestones. This section deals with how they value certain assets and liabilities. Their cash and cash equivalents, which are the most liquid assets, are valued at face value. But then you have things like the earnout liability and warrant liabilities, which are fair valued using complex models. The earnout liability, valued at over $16 million, is particularly complex, relying on unobservable market data, which puts it in the level 3 category. This means their valuation is based on assumptions management makes, and those can be subject to change. NioCorp operates in one main reportable segment, exploration and development of mineral deposits. Specifically the Elk Creek project, they do not generate revenue from operations yet. The Chief Executive Officer, who is the Chief Operating Decision Maker, reviews performance at a consolidated level. This tells us they are laser focused on this single, large project as the path to future success. Looking just beyond the 31st of December 2025, from the 1st of January to the 6th of February 2026, NioCorp issued another 4.5 million shares from their equity facility, bringing in over $31 million. This shows they are continuing their strategy of raising capital through stock sales even after the reporting period ended. This entire section is management explaining what all those numbers mean. They are very clear no revenues from mining operations have been funded by selling stock and other financial tools. They are upfront about needing more capital for construction and commercial production. This is where they lay out all the potential risks and what they hope will happen. They talk a lot about needing financing, Exim Bank involvement, and the general uncertainty of commodity markets. They are also very clear that their projections are based on assumptions, and the actual results could be very different. They mention potential challenges like cost increases, supply chain issues, and even becoming a passive foreign investment company, which can have serious tax implications for investors. Here they break down their expenses. Employee costs are up, professional fees are up likely due to all the financing activities and legal work. Exploration expenditures are way up, which we saw from the cash flow statement. Other operating expenses also saw a jump. A key point is the significant increase in adjusted net loss, which excludes certain non-cash items like changes in the fair value of liabilities. This adjusted loss also widened considerably, showing that even when you strip away some of the accounting fluctuations, the underlying cash burn from operations is increasing. This is the heart of the matter for any investor. NioCorp has no operating income. They have raised about $139 million from their October offering alone and continued to pull in cash from their equity facility and from warrant and option exercises. They estimate their planned outflows for the next year are between $70 and $85 million. This covers continued work on the Elk Creek project, corporate costs, and financing efforts. The big elephant in the room is securing the full financing for construction, which they estimate at over $1 billion. They are actively pursuing debt and equity, including the Exim financing. They are clear that future financings will likely dilute existing shareholders. They mention no major changes here except for new estimates related to valuing goodwill and intangible assets gained from that recent acquisition of Fee A Materials, LLC. They use adjusted net loss and adjusted net loss per S-hair to give a clearer picture of operational performance by excluding things like changes in the fair value of liabilities. For the 3 months ending the 31st of December 2025, their adjusted net loss was about $5.5 million compared to about $1.9 million in the prior year. For the 6-month period, the adjusted net loss ballooned to over $13.7 million from about $3.3 million. This shows that even with adjustments, the burn rate is increasing. This is a critical warning for any US investors. NioCorp believes they have been classified as a passive foreign investment company, or PFIC, and may continue to be. This can lead to very unfavorable tax consequences, including higher taxes on gains and potential interest charges. They strongly advise investors to consult their own tax advisors. This is not a trivial detail. It could significantly impact the returns for our shareholders. So, what is the big picture here? NioCorp is undeniably in a high-stakes game. They have secured a significant amount of capital recently, which is a major positive demonstrating their ability to attract investment for this massive project. The increase in cash and the progress on the Elk Creek project, including the recent acquisition and drilling programs, show they are making tangible steps forward. However, the story is far from over. Their losses are widening and they still need a colossal amount of funding to get the project off the ground. The market's perception of their future success, heavily reflected in their stock price and the valuation of their liabilities like warrants and earnouts, is critical. The risk of being a PFIC is also a serious concern for us investors. Ultimately, NioCorp's future hinges on their ability to secure that massive construction financing and execute their project plans without further major setbacks. It is a high-risk, potentially high-reward scenario. The company's direction is clear. Build the Elk Creek project. The strengths are their recent fundraising success and clear strategic focus. The weaknesses are their continued heavy losses, significant capital needs, and the inherent risks in complex resource projects. The major opportunity is the potential to become a key domestic supplier of critical minerals. The biggest risk remains securing financing and navigating the complex regulatory and market landscapes. Alright, that is our breakdown of NioCorp's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they will secure the financing needed? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps. And of course, subscribe for more deep dives into corporate filings. And don't forget to join our Discord community. It's linked in the description. Thanks for watching. See you next time.